do this. Hey, everybody, Economic Ninja here. I hope you're doing great. I've got a special guest on, Patrick Karim of Bad Charts. Patrick, how are you doing?
How you doing, Ninja? Always a pleasure to be with you.
I'm super pumped because I need you to explain to me and to everyone out there watching this video right now. We have so much turmoil in the markets. Markets keep trending down. The dollar keeps getting stronger, but it's the dollar getting stronger in the DXY. I've been telling people this like crazy lately, that the euro is a basket case, literally, and it's making the dollar look strong, even though people are moving into it because they're selling off their stocks, their cryptos and stuff and moving into dollars. The DXY is up against the euro. So you've got some interesting charts, and I want people to stick around because you have a chart that you're working on that is very valuable, because we need to weigh the dollar not only against the euro, but also against gold and silver, things like that. So jump on in. Where do we take this thing?
All right. Well, let's get right into it, guys. For all the chart geeks out there, look, the charts, Travis, it's great to visualize, and really it helps frame whatever narrative, whatever's happening.
Yep.
When we see a chart, like, everybody reacts positively because, yeah, of course, it makes sense, when you see the chart with the time frame.
Yep.
So right here, guys, what we have is the gold or orange line. Sorry, guys, I'm colorblind. It's the DXY.
Yep.
And under, it's the gold divided by silver ratio. And the gold divided by silver ratio, look, gold and silver are financialized instruments, guys. And if ever there's a risk off situation, silver will get sold off hard. Gold will get sold off, but not as much. And we got to know that the gold silver ratio is mostly driven by the silver price inversely. So this ratio right here, it's moving primarily because silver is more volatile than gold. So if ever, when you see these spikes, guys, 2003, even here it started 2001, 2008, February 2016 was a bottom for the precious metals, but also the US equities were having a hard time. Look, March 120, like, it went up, the gold silver ratio.
Yep.
So when we have these spikes, it's market sell-offs. Usually, like you said, all the money goes in DXY before it finds a new home. People sell DXY, and then they decide, okay, what am I going to do for my cash? So here it is. DXY spikes pretty much close to when the gold silver ratio spikes. And as soon as the gold silver ratio unwinds, that's the market telling us, okay, guys, the worst is behind us. It's let's start pricing in this monetary imbalances. And usually gold and silver run off the gates ahead of the US equities.
Yep.
The DXY, the reservoir of US dollars, it goes back into gold and silver, US equities. As this unwinds, it bottoms. You get a spike up in the GSR, gold silver ratio spikes up, DXY spikes up. And once that the gold silver ratio starts unwinding, same thing, the DXY goes down. And that's what, look, it's crazy where we are today. We're back at levels last seen in the dot-com bubble, like in 2000, 2003. The gold silver ratio behaving predictably, just like before, indicating that we're in the possibility of a crescendo move up, a market liquidity event. So even if the markets today, guys, on the daily chart, they seem to be going up, as long as the gold silver ratio does not break below this line, guys, stay clear of this freight train. This, at any day, huge selling could come in and just wipe all the gains. You think you're smart doing a day trade. It's super difficult as long as you're above this line. And the DXY nominally, it could just keep going up and up until the markets sense that there's going to be a Powell pivot, some type of event which people will say it's safe to go back in the markets. Let's start buying stocks again. Let's start going gold, silver, and all those instruments.
Well, it's interesting that you say, and it's good that you say Powell pivot and people feeling better about going in the markets. I'm going to be honest with you. I don't think the Fed can raise rates much longer because there's so much pain in the markets. You not only see equities selling off, we see trouble in the bond market, but then we also see real estate starting to top and starting to correct now nationwide, where we're starting to see price reductions because mortgage rates are exploding. That Powell pivot could happen, in my opinion, pretty soon. What do you think about it?
Yeah. I did some charts. I think within 1 to 3 months, the markets are going to start pricing in that it's over for the rates. They're going to pause. And after that, they're going to start going down. But we're going to know ahead of time, because when gold breaks out versus the SPX and it starts pricing in this gold's going to break out versus the SPX probably a month ahead of when the Fed finally announces that they're going to flatline. So gold could be breaking out even when the Fed does a hike or like one of those planned hikes, but you got to trust the price action of gold that it's going to lead what the Fed's going to do. They're always behind. It's never the Fed. People think the Fed leading. They're slaves to what the market decides.
I completely agree. Now let's talk about market sentiment turning, because that's happening in Europe right now. The ECB having emergency meetings and trying to stabilize what appears to be right now as a currency crash because their markets are collapsing. They are trying to pull out every stop in the rule in the book. They're trying to pull out right now and put to work, but things aren't working well. Christine Lagarde said they went from essentially they were going to raise rates to now they're looking to lower rates. They're looking to buy assets. And you are working on a chart right now of the euro. Isn't that correct? You were able to show them ahead of time what you're working on right now?
Yeah, guys. So you get.
And let me just, a little plug. I want people to go and check out your work on Twitter. And what is your handle on Twitter? It's probably popping up somewhere in one of these.
Bad charts one, guys.
Perfect.
Go check it out. All these charts, these macro charts, they're all there. I have a member website, but if you don't want to bother with that, there, just stick with Twitter. You'll get a whole bunch of stuff.
Yeah.
Here, check this out, guys. So here, what we have is the euro area Fed fund, the lending rate, the overnight lending rate.
Yep.
And I subtracted the Fed fund rates. So this is back in my Forex days. I remember the most important market movers in the currency pair traders was when they would announce or the market pricing in rate hikes, right? Because just like, everybody knows for years, Japan had low interest rates. Australia used to have more. People would go long Australian dollar, short the yen, and they do the carry trade, right? They collect the interest differential.
Yep.
So my theory was here that the delta between the Fed fund rates versus the euro, that would decide the flows. Am I going to hold over, if I had cash, am I going to hold euros more than US dollars?
Yeah.
Of course, you're not going to hold euros over US dollars if you're making negative money, right? Holding the euros, you're going to hold the US dollars. So here it is, guys. Here's the zero line right there. As when this line goes up, guys, that's the euro either rate hiking more than the Fed, or the Fed pausing, or the Fed cutting. But essentially, it means you're getting more and more yield off the euro if you subtract what the Fed's giving you. And yep. all these moves up, and you see here, look here at the bottom, guys. I have the euro versus the USD. So when we had these changes in sentiment or in direction of the ECB giving you more rates than the Fed, the euro bottoms, and then after that, what happens is the euro goes up. Then when each time you go here in this lower band, here was an important low. The ECB was really behind the Fed in their rate hikes.
And I'll remind you real quick, guys, June of 2006, what was happening was Germany in mid-2005 was going through a lot of issues. They were moving into a recession. They were going to possibly pull the euro down with them, the rest of the European Union. And so the European Union had to start acting. The ECB had to start doing measures to pull Germany out of that funk. And most people don't realize that is exactly what happened those next couple of years. And then Germany, ironically, in 2010 was the best smelling turd in the punch bowl. And everybody had forgotten that they were the ones that actually helped aid bringing down Lehman Brothers because of some interesting bets. Anyway, sorry, I digress, but I just wanted to make that point.
That's great. I love knowing, like, you understand all these milestones that happen. I look at the chart, but I don't know what was happening under the covers. It's fun hearing you. And as that was turning up, well, what happened is people probably thought it was the end of the world here for the Euro USD going down, but no, Europe started giving more rates, more yields overnight than the States. And then what happened? Euro USD went up, and over here we topped. And after that, a vicious cycle in favor of the US dollar instead of the euro. So even if they were both decreasing the rates, the ECB, they were lowering it faster than them. And that gave some huge headwinds for gold right here. Here was the gold top.
Yep.
I'll overlay gold here. So here was the gold top when the ECB and the gold's going down, until right here, when we're back in this historical support zone, the ECB or the Fed started cutting ahead of the ECB. So that gave a huge boost. And look what gold did when that bottom.
What date? You've got it covered up. What date is that? That bottom?
March 2019.
Okay, perfect. Perfect. Yeah. So guys, the reason why I want to explain that, why we started heading higher, is because the interbank lending rate was already starting to suffer. Banks were not trusting each other in the spring of 2019. By September, it hit fever pitch. The interbank lending rate spiked to 12%. To give you an idea how bad that is, 9/11 and Lehman Brothers collapse of 2008, they hit interbank lending rates of 6% and 6.5% respectively. And so what happened was the Fed started opening up the repo window and started aggressively easing prior to the whole world shutting down.
And look at that marked. So this is like, you could call that a pivot also, right?
Yep, totally.
So I'm expecting, and look at that. So we're using technical analysis. So this, I know it's a historical spot where, and this is an oscillator, right? So it goes up and down. Like there's a balance in between all these central banks. They can't go too crazy in one side. They can't kill the euro, the Fed. Like eventually it oscillates up and down, and we're at the bottom of the oscillator right now. So I'm expecting at any moment, guys, we're closer to a bottom in favor of the US dollar. So when this turns up, gold's skyrocketing up. The DXY chart where we showed you on the previous page, that's probably going to top out, is going to start going down.
Yep.
So this is just a question of timing. So I don't know like exactly when this is going to happen, but this, you got to keep your eye on the price and look at it's this type of move here, this type of line here, we got to wait. As soon as this line breaks out to the upside, as soon as gold breaks up to the upside, this is a type of move I'm expecting. But I would be scared holding gold if the Euro USD pair was all the way up here. You could be in a more dangerous situation. Doesn't mean you're topping, but a more dangerous situation. But I know that every time we were in this bottom range, those were bottoms. These were power pivot moments there. Yeah. Come on, Mr. Chairman, it's time to pivot.
Yeah, I agree. But I think the ECB is going to pivot much faster than the Fed, because we are having a decoupling happening right now. The euro pair to the dollar is completely exaggerating and getting worse. So I would expect literally in the next 2 months, that's just my personal opinion, to see the euro start to increase because of what the ECB is going to do.
You mean they're going to stop raising rates?
Yeah, I believe you are going to see the ECB start to take drastic measures to monetize debt, to lower rates, to do everything they can to save a failing currency. I believe you're going to see that within the next 4 weeks. With these emergency meetings, it's almost guaranteed. Emergency meetings always happen before drastic measures. And you're already seeing, like when Draghi came out back in 2010 to 2012 saying, at all costs, we're going to save this. We're going to print as much money as it takes. We're try and, essentially helicopter money. They're going to do everything they can. And now Christine Lagarde is starting to tout that as well. But I don't think they're going to last much longer, to be honest with you. I'd be surprised. This is going to be crazy. I'm going to make a prediction that this isn't a financial prediction, or, don't trade off of it. But I'd be shocked if you saw the euro a year from now.
Wow. Okay. That's a total annihilation.
I think so, because you're going to have countries like Germany that are now, ironically, the stronger one, because Italy's, bonds are imploding. They're going to sit there and go, we don't want another round of bailouts where we're bailing out other countries and ours is strong. I'd be shocked, to be honest with you.
Well, just as a historical note, I was always wondered, because I have some Euro USD charts that go back to the 70s. And I said, how's that possible? The Europe was, but it was based primarily on a basket, which was the Deutsche Mark was the primary driver of the euro. And it is today. So the Deutsche Mark, if you don't put all these other countries, like bring it down, would probably look a lot better versus the US dollar if it would.
Yeah, it was similar to a basket of currencies like the SDR. That is exactly what you're talking about. Yeah, because the euro came out in, I believe, 2000, 2001. But that pair was actually a basket of currencies, the best of the best, what they thought. So, well, hey, in closing, Patrick, do you have anything you want to share with them? I know we talked about following you at at Bad Charts 1 on Twitter. Anywhere else?
Yeah, well, guys, look, if you want with Kevin Wadsworth, North Star Charts we have a website called northstarbadcharts.com, and it just happens we have 60% off our yearly subscription, guys. It's true. Come and check it out. It's and we give more in-depth actionable chart items in there. But just start, guys. Observe what I do on Twitter, and And just be careful, guys, right? Remember the gold silver ratio, it's telling you be wary that something could happen. So you got to really wait until it tells you it's time to deploy your cash.
Yeah, I completely agree. Although with buying physical, I will warn people, we have seen elevated premiums where even if the price goes down, it seems like the premiums shoot up because everybody's diving in to buy physical. So we, like you said, when you're investing in paper shares or mining equities, things like that, those do take hits, right, Patrick?
It's anything that's liquid, that's traded on COMEX or on the markets. They'll all follow these capital flows. You can't, there's no mercy there.
Totally agree. All right. Well, thank you so much, Patrick. I really appreciate having you on.
Thank you, Ninja.
Right on. Well, everybody, I hope you have a great day. With that being said, the Economic Ninja is out.